I've been waiting all day for it. Stitch Fix earnings, that's right. Definitely something I was excited about. Obviously, is a newer position for me, one that I was up pretty massively on, and, well, here's some bad news. We're down 6% after hours. So we're going to take a look at these earnings and see why exactly, in a quarter that I expected to be a decent quarter, what happened. So I do want to start this off by saying I didn't expect the stock to go down regardless of what they posted, just due to the fact that I didn't really know how much more of a upward move we could really see. We're talking since April, the stock's up 100%, right? There wasn't, in my opinion, I didn't know what the momentum would be to be moving this thing continuously upwards. So that's exactly why we saw a pullback, right? Nothing unexpected. If we look specifically off of these earnings, first we see an alert here, Seeking Alpha trying to be promoting their stuff. But here we go. EPS missed by 19 cents. GAAP EPS of negative 33 cents. Yikers. It's no bueno. I expected a miss on this aspect for sure. I did anticipate a miss. A little bit higher of a miss than I really expected, but no bueno. From a revenue perspective, we saw a 9.1% decrease year over year, which missed by 42.81 million. But active clients rose 9% year over year to 3.4 million, and net revenue per client rose by 6% year over year to $498. So you may be questioning, obviously, how does active clients rise and net revenue per user rise, but somehow we saw a revenue decrease year over year. Well, a lot of it can, it really stems from a lot of the other services that they offer too. If we talk about people just buying outright from them, that could be a big part of it, but we'll look at those slides here just a little bit. Well, they didn't produce slides. Sorry, we're looking at the earnings release. And you look at this miss on a revenue perspective, and I expected a beat. Let's be fair. So I was wrong. But if you put it into perspective, we talk about the other clothing retailers that posted a decrease in by 60% of year over year, 60+% on some of these companies that are clothing retailers, and most of them really didn't get anything below 50%. I mean above 50% really, as far as loss is concerned. Loss was stacking up for these companies big time in revenue. So putting it into perspective for a clothing company that's solely clothing based, Stitch Fix did a pretty good job. I can't lie. I certainly can't lie, especially when you see the fact that you rise in active clients and net revenue per client. That's very nice. Some of the finer details here. Stitch Fix reports an increase in active clients. Heck yeah. The retailer generated adjusted EBITDA loss of $40.3 million during the quarter versus $0.3 million a year ago. So quite an increase in terms of loss. It gives a small look at the balance sheet. I'll look at that certainly. The CEO here says that in a time period where the broader apparel and accessories market saw sales declines of 80%, we delivered $372 million in net revenue and expect to return to positive growth in Q4. Obviously, this being Q3, so they're expecting next quarter to be better. We believe our business model and balance sheet uniquely position us to thrive in retail's next era, which I believe it certainly does, and that's why I've invested in the stock. We're excited to demonstrate that in the quarters ahead. Let's go. So looking at this earnings report here, obviously they're going to be excited about this. Active clients, big rise there. You love to see it. Net revenue loss is not one you love to see, but you know what? It could be worse. It's a company well positioned. They didn't really pile much here into this earnings release as far as what they did. Pretty lazy, there's only a couple pages. They really have their balance sheet, stuff like that. So obviously you got to mention here, what is the future of clothing retail? And regardless of the situation, you think about how online has a bigger play, and a lot of the traditional clothing retailers don't have as big of an really online presence as they need to. And a company like Stitch Fix benefits quite a bit because of the wide variety, as well as just the convenience that they offer. Delivering their clothing really to your doorstep is pretty big when we talk about the future for people in online retail. There are people that, because of the current pandemic, have really finally experienced the benefit of online retail, and there's a chance that they might do a majority of their shopping specifically online now. Now, With clothing, I do believe that physical retail is still going to be around for a long time. Physical clothing is very important. People need to try things on. You can't just look at a picture and say that would look nice. It's the same reason why it's pretty hard to buy furniture online as well. It's hard to buy a mattress online. These are some things that you need to actually see in physical space or experience to actually know what it's like. Now, I'm not saying the market's not there, but it will continue to grow, and I think both the digital market as well as the in-store market will tend to grow. So Stitch Fix just offers a really nice service, especially in the environment of an increase in influencers. Stitch Fix just really has a lot to gain here. So I think long term, I really do like this. Looking at this balance sheet, they gave us a snapshot, but total assets of $781 million. That is versus $616 million of a year ago, or 6 months ago, I guess. That's great. Good. They're giving me 6 months ago. But definitely positive in that aspect. You see a rise in assets. Now, the question always becomes, did they raise capital? So does liability increase? Let's take a look. Total assets as a whole, or total liabilities of $220 million versus $359 this year, or 6 months later, I should say. So they rose that by 100, right around 140. And guess what? They rose their assets by right around 160, 170. So overall, definitely net positive gain. BGC in the total stockholder equity, $422 million versus $396 of a year ago, 6 months ago. They're really tricking me with this 6 month ago nonsense. But from my perspective, very excited on that aspect. I'm pretty excited. I think that they're doing a great job. As far as this balance sheet's concerned, it's very well positioned. You see a lot of these new starting tech companies that really, they're money losers. Balance sheet's not quite there, but a company that have twice the assets that they do in liabilities, I do like that from a company like this, and I think they have a lot of room to grow. So as far as buying positions, I really liked this thing down in the 15, 16s when I got it. I really liked it. I purchased it in the 16s. I really like it. Anything under 20, I really like for this company. Now, as far as the likelihood of getting below 20 in the short term, I don't know if I necessarily see it. I think the momentum will continue for this stock, but if you can get this under 20, I suggest it. And I'll likely add to my position under 20 as well, but just something to look at. Pretty cool.